Thanks, David, and morning. As David mentioned, one of the founding partners of the DRC real estate debt business. We started our debt business about 15 years ago, but for more than a decade before then, I was a senior risk taker in the fixed income trading group at Merrill Lynch, covering the corporate credit universe as well as the entire asset-backed complex. So trying to draw on a bit of that history and experience to answer this quite difficult question of relative value. Right. Before we get to the meat, though, let's think about macro. If you don't have a view of what the probable macro regime is, you're going to find it pretty difficult, I think, to think about this relative value question. So here's my view. This is the ECB forecast for GDP growth and inflation. Unsurprisingly, they think we return to trend. Most central banks are unlikely to predict a recession. Now, if you look at forward-looking and even some current activity indicators, it would seem to me that the greatest probability of deviating from that forecast is likely to be for the downside. So in our view, we see sort of trend or probably weaker growth. Similarly for inflation, with a global slowdown seemingly upon us, we think that the trend in inflation is also likely to be lower. That's the kind of short to medium term. I have a feeling this has got, back, hang on. Medium to longer term, there's a couple of things to think about that I think will continue to reinforce that trend. We see the European population likely peaking and starting to decline slightly, and the mix of that population also is aging. That means that the spending power of the greater proportion of society, I think, is likely to decline. This reinforces this sort of weak growth, weak inflation. David, I have a horrible feeling that this is the old version of the presentation. But let's keep going. So with that macro regime in view, weak growth, weak inflation, what kinds of assets are suited to which kind of regime? You might be quite familiar with this chart. I think it's pretty helpful in framing the high-level asset allocation. My view is, I think we're going to spend most of our time in regime 4. Weak inflation and probably pretty weak growth, possibly some time in regime 1, with the high-level conclusion being, though, that credit